Hi, this is Randy Finney with Right Side of the Chart, and today is Tuesday, January 23rd, 2024. It's 10:37 a.m. Eastern Time. I'm starting the video, and I'm going to do this one a little bit different. I usually start out with the equity markets, sometimes end up getting in detail with those in depth, and I do want to do an in depth, but I'm going to do it a little bit different this way. I'm going to start out with the other two components of what I call the big three, and that's interest rates, i.e., primarily Treasury bonds. We're looking at that. And then the major currencies, the euro, US dollar. And I also want to do updates on the other stuff because, again, the equity markets are just one of many, many things out there to trade. So I'm going to cover the precious metals after covering the euro, US dollar, because they are definitely affected by the trend in the dollar. And that'll be gold, silver, platinum, palladium, GDX, everything I've covered recently. Just going to give you updates there. And then some of the ag commodities. I'm noting some developments today worth noting in the grains particularly. And time permitting, I'm going to do Bitcoin. And then also dig down and get the indexes last. But what I'll probably end up doing here, if this video goes too long, I'll try to keep it under 30 minutes if possible. Then I'll cap the video and then cover the equity markets in a separate video. I'm going to start out here. You can see we're on the economic calendar. That's available on the site under the resources on the top menu. Once you go to that page, go down to tools of the trade. We have it's pretty light until Thursday. This is the big day right here. You've got a lot of stuff, the potential market moving stuff. Durable goods at 8:30, GDP 8:30. Jobless claims. So you can see got a lot of stuff there. New home sales at 10 p.m. So a pretty heavy calendar then. But what is likely to move the market before that even happens are the earnings reports. We've got a slew out there today. I think Netflix is after the close today. We're starting to really heat up into earnings season. So just kind of a sidebar on that. One of two things. When you look at any of the big names, especially when we get down a couple weeks from now, or not even, we'll get to the big tech stocks. And I looked up. That's just over a week away, about a week, 10 days. You start to have all the most of Mag 7 reporting. So that's something to watch for. And the takeaway there is, number one, if you're swing trading individual stocks, be aware of when your stocks report. That is also available. The earnings calendar is also available on under the resources tools of the trade segment on rightsideofthechart.com. You can type in any symbol, see when they're going to report, or you can just view the calendar and see who's reporting this week. So something to note, because that is going to lead to increased volatility in gaps in either direction, particularly if you're trading a certain position. And then where I was going with the big, Mag 7, they really have the potential to move the market. And so be advised that they're coming up soon. Okay, let's look at one more thing here. A couple other charts just to kind of recap this one again. I've covered it. This is the federal funds rate 62-year historical chart. You can reference this on macrotrends.net. There's some other sites out there that'll do it, and this is what I've talked about, and others that you see. There's always a inversion when after Fed hiking cycle, rates tend to plateau. I think you can see it there. Sometimes they just peak quickly, but usually there's a plateau first, like right here, right there, and then the recession follows. Remember, recessions are almost always declared in hindsight, at least the start points, and quite often the end points. And so by that metric, along with this one, I know that the market has written off the hard landing, even the soft landing scenario. The no landing seems to be the scenario du jour. But there is that. And then the other one, too, is the yield curve. Let's not forget that. That's an important one as well. It has a 100% track record, which is rare for any type of economic predictor or indicator. And as noted, it is not the inversion of the yield curve. Inversions when you cross below the red line, which is meaning that's where the yield curve inverts, which means in this case, the 10-year is paying less than the 1-year bond. That's very unusual. You only have seen that preceding recessions, but it's the uninversion when the lines cross, when you cross back above, that the recession typically then follows. So you can see all these inversions and then uninversions, they call it, right there, there, and the shaded gray area, hopefully you can see that in the video. This one was over before you knew it. That was a COVID, little quick, and recession prevented by the Fed and the central banks. But you can see that. This one's from Guru Focus, is a website, and you can see we've been moving up, but we have not uninverted on the 210. I'm sorry, on the 110 or the 210. This is the 2 and 10 year, but you can clearly see the trend is rates are short-term rates are moving, not moving. The spread is closing. I'm sorry. The inversion is getting close to uninverting. There it is. So meaning basically you're going to have a drop in the longer term bonds, which we've seen, but you should have more of a drop, and that's what's happening so far. Short term rates are dropping larger in percentage terms. That spread is decreasing because they were pricing in the Fed cuts. And although long-term yields have come down, they're not coming down as much. That means we're headed back towards a more normal yield curve. And again, you can see here every instance after the uninversion was followed by the recession. So it's not a timing indicator. That's the thing. Even if we uninverted today, tomorrow, next week, we're not going to do today or tomorrow. It's still just kind of a, hey, heads up, it's coming, or at least historically it always has. Okay, now let's dive into the charts. Let's start with bonds first. Treasury bonds, we are, I think I did an update, was it on Friday, on treasuries right here. For all intents and purposes, we've hit the T1 zone. That's the first target zone on the short side. Remember, this was a long here. We entered right there, wrote it up. That's the fourth and final target. And then somewhere in here, I reversed that to a short. And we've been going down. That's been the most crowded trade in one of the most crowded trades in history, really, or at least in recent history, in the financial markets, not equity markets, of course, fixed income market. And you can see we've come down pretty steadily. That means, again, very important, this is the Treasury bond price, that this is the tracks the 30-year bond, really, 20 to 30-year bonds in there, holding a lot of 30s. And they are moving down in price, which means yields have been moving up. And like I said last week, I believe it'll be incremental. I can't guarantee we're going to go back down much more. Like I said, we're coming up to a target zone. That's usually where you're going to get a bounce. However, again, it's been such a crowded trade, nothing would surprise me. And I'm taking this one day by day, minute by minute, and watching it, because I do believe this is where we'll start to see increased sensitivity to rising rates. Remember, bonds price drop, rates go up. And so then that opens the door. If we do take out the bottom of T1, first target zone, it opens the door to the second target zone down here. And there's still that potential third target zone. Doubtful we're going to get that low, but certainly possible. And the most important takeaway, if you see, the long bonds continuing to fall in price, yields going up, this would be, in my opinion, you get anywhere close to that low from October. That was the multi-year peak in yields and bottom in the treasuries. So if you get anywhere close to that, I think you'd have the market freaking out. But either way, that's where the trend is. There's no signs of reversal yet. Like I said, we are coming up to some support, maybe a back test of this trend line. IEF is a 10-year, and the 10-year is still holding that uptrend line support I highlighted last week right here. And so, like I said, maybe you have equal lows there in the RSI, and ever so slightly lower low in the PPO. So we could certainly bounce. And I'm not talking, this is a little hiccup. That's that hiccup reaction off that trend line. but I am my convictions aren't strong. Let me just say why I will cover this, and I'm watching it is not so much as for a trade idea right now. We've already thrown that out. I think we've milked a lot of the initial leg down after milking almost all the run up, the previous run up. It's more so to kind of get an eye where the equity markets are going to go, because if they continue to ignore right now, they're really kind of dismissive of this backup in rates. This is the 10-year yield right here. Let me show you a daily chart. Turn off all the lines. So this has been the uptick in yields, and the market has shrugged it off with the S&P just punching, slightly taking out the previous highs recently, yet despite rising rates. Because again, it is showing you that the market is dismissing this as just a counter trend bounce and believes we're going down. And hey, I do think in time, in the more intermediate term, not the very near term, that's a little obscure to me. Intermediate term, I do think yields go down lower, but I also think it'll be due, the next big move down will probably be due to a flight to safety bid from volatility in the stock market. But either way, if this continues on up anytime soon, that's where the market will start to really freak out. It did it back here and here, really right here. That's where everybody had written off. They thought the peak, the vast consensus was yields had peaked here. And when they went over to start making new highs, this is where we had that big correction where we traded down and hit that T2, the second downside target in QQQ, because of that rise in yields. And only when the market clearly saw those yields were abating did we get this recent thrust up that we're in right now, this current uptrend. Okay, and so treasuries are one of my big three, with stocks or the stock market being one, treasury bonds, particularly the yields, but the prices are directly inverse to the yields, so there's no variation there. The euro and US dollar pair, I like to use EUR/USD. It's kind of a proxy for the dollar index. You can look at the dollar index most certainly, but the euro has almost a 60% weighting. It's by far the largest. I often mention that, but it bears repeating for new folks coming into the site. And it has been moving lower, and lest the market forget, there is a very, very strong correlation. FXE is the Euro ETF. I'll turn off all these lines and just show you that correlation between the stock market and the Euro. We'll look at QQQ because that's where the juice is. And I think just about anybody, you do not have to be an expert technician, meaning chart reader, to see this very strong correlation. Look at all the peaks and troughs right there. The lines aren't going to overlay because the stock market doesn't move up and down in the same percentage terms that currencies do. Currencies move in much smaller percentage terms, but you can see the overall trends. It is unmistakable. So make no mistake about that. You can trade longer term. You don't want to use it as an exact timing indicator because there are periods of brief disconnects of this relationship, but it has been very, very strong and highly positively correlated. And what's going on now is, like I've been talking about, the market's not getting the memo. Let me turn that off, that comparison. All right, let's turn that off. Go back to EUR/USD. And I just used FXE because it trades the same regular trading session hours, 9:30 to 4 p.m. that the QQQ does. This trades around the clock. And you can see here, as I've been talking about, we keep getting this disconnect. So the market is just punched out the all-time highs. And that was yesterday. We're down today, not by much, but a little bit. And see, the euro is not, EUR/USD is not punching through new highs or all-time highs or anything close right now. In fact, the trend remains lower. So this right here, something's going on there. And you could see this was, remember, we had a target zone. It was posted here. It's either a direct play if you wanted to short the euro or get out of your gold, short gold, gold, silver, whatever the market. And the market did go down there. And then this is what's happening here. We had a divergent low. We broke out. There's a case for the euro to rally off this, divergent low, but so far it hasn't. And that's the most important thing. So there's that first target zone. It was a target zone on the way down because it was support. Support, once broken, becomes resistance. So it's no mere coincidence that that's where we got rejected. That was a rally into the top of that target zone, which is now a resistance zone. Again, support on the way down. We hit it here, we bounce. We hit it again, we bounce. Then we undercut it. And since we undercut it and took it out, boom, 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 the top of that's been resistance. And so now we just hit my next support level, 108,334. Those were actually old. I'll have to update this line. I'm not putting too much faith in this line. In fact, you know what I'm going to do right now? These were the previous. We had shorted it here, helped align a correction, gold, silver in the markets back here. I gave you 3 targets. We hit the third and final one there. Had ever so slightly lower divergent low. Got long equities, covered all shorts, rode that up at the time, and that coincided with a bounce in the market. This and this is that disconnect I'm talking about, and it's not being priced into equities. So one of two things is going to happen. If this continues and the euro continues to fall and the stock market continues to go up, there's going to be, the longer that happens, the more powerful the mean reversion is. And the mean reversion is going to be either the euro plays a game of catch up to the stock market, or the stock market plays a game of the catch up down, falling down to the euro. Or a combination thereof. You can see that too. You can see the euro start to move up, the market go down. But this is unusual, and it's not as of now being priced in. We're down. You can see we just took out the recent lows from, where is this? Back on the 17th of this month. And you can look at QQQ, where it was on the 17th was right here. And so there it is. So the market has gone up over that period of time while the euro has fallen, and that's not being reflective. Again, I'll get to these charts either at the end of the video or in the next video if I have to truncate or cut this one short and start another one. Okay, gold is another one like the stock market that has a high correlation with the US dollar and or the euro. And this is my daily chart of gold, but let me turn off all the lines and just show you that correlation here. Edit chart properties, compare it to FXE, which again is just the euro ETF. And you can see, again, they're not priced in the same percentage terms, so these lines are not going to overlap. But what you want to look for is the trends. And there was a disconnect there. You could see the euro continue to fall. And then, but that's where we had gold rallying. There were high positive correlation right here. Very strong correlation there. You had a peak in gold right there. And then the euro peaked right there. And you can see very, very, very tight correlation throughout most of this. Major peak in both of them right there. That falling. Gold's been resilient. Major bottom right there. And all these peaks, 1, 2, 3, 1, 2, 3. And then you can see, so there's a little bit more variance here. But certainly the correlation is very clear and unmistakable. And I will give gold credit. Gold's been holding up. There's been a good fundamental case. I know some people are gold bugs. They're always bullish on gold no matter what it's doing or what the technicals look like. But I'm hearing more and more, folks making a case for gold fundamentally, and I can see it. So let me turn off this line. Before I do that, let me just show you the correlation here. So right here, here's the most recent correlation. And you can see it when I zoomed in like that. You can really see those lines overlay because I'm zoomed in a little tighter. You can see just how perfect that correlation is. Couple periods of very brief disconnects, but then the correlation returns, right? I think you can see it all there, both bottoming here, moving up. And so lately, again, you have the euro here in blue, and it's been falling. Gold has been moving down, but not nearly as much. Now let's zero in on gold. Again, the takeaway is keep an eye on the euro, the US dollar, if you're trading gold and silver, even if you have no desire to trade the currencies. All right, let me turn those comparison lines off. Kind of go down to a 60-minute chart here. So you have, it's not written here, but I'll borrow this one here, duplicate that, take that. we have this recent divergent low. I've been highlighting we've had divergence on gold and silver, so it's hanging in there despite what the euro is doing. It's not moving up. It's having a hard time because again, the falling euro, the rising dollar has been a headwind to gold. But you can make a decent case right here with this divergent low. It's wash, rinse, repeat. You can see the previous lows and highs, divergent lows and highs here and there. Divergent low right there. You got your rally, really peaked there. Then you went down. That was actually, it's not marked on the chart, but go figure. And that was a divergent high right there. You can see the divergence lines. Just borrow that one, put it over there, and equal highs in price with the lower highs in the indicators. All right, you can see it there. Divergent high, divergent low, rally, divergent high, correction, divergent, another divergent high, drop, and now divergent low. So, like I said, I won't make a screaming case because I'm not screamingly bullish on the euro. If I could make a stronger bullish case on the euro, bearish case on the dollar right now, I'd be able to make a more confident call on gold and silver. But with that being said, and I mentioned it yesterday, I think they also right now, besides I can make a case to buy, I can make a decent case, not a solid case, again a decent case to be long the metals. Silver has this very, very, not very well defined because it's pretty good support level. We've had a lot of rallies off that level, but we've also had a few false breakdowns followed by very strong snapback rallies once we recovered that level. Came here, another false whipsaw down below, and a strong run up. All these, at least these marked, ended with divergent highs. This is swing trading. This is, where if you're a buy and hold investor or a long-term trend trader, the only trend in gold and silver, at least in silver especially, and gold, is sideways. So you've made nothing and you're not getting dividends. It's been going on for, goodness, a better part of almost a year now. This is a 60-minute chart, but you're going back there. So there it is. So you have the divergence. You're below support. Safe bet would be to wait and see silver take that out. It's about 2062, but again, 2062-ish because you've moved through it a few times. But that's that. So that's how silver looks. GDX, that's gold mining ETF. We had a divergent low, I pointed out recently, and just like gold and silver, we went a little bit lower, but it's still a divergent low, especially on the, you can see on the daily chart as well. Again, a trading vehicle lately. Up, down, up, down, up, down. And when you look at the daily chart, I do have a decent support level here. It's not super solid, but it's decent. It's where GDX has fallen to before, and the buyers stepped in. If it takes that level out, next support is down here about 26-ish. And then recently, I told you I like platinum and palladium as well. This is palladium. I'm just going over the ETFs now. If anybody in the futures, let me know. I'll be glad to put up the charts for palladium, platinum, gold, silver futures. But I know a lot seems the consensus, or the majority, on this site, trade ETFs. So I try to cover those as well. So there it is. We had that last time we had a divergent low. Palladium can really run when it wants to run. That was about a 35% rally into that divergent high. We're coming off another divergent low recently. I highlighted this one, I think, last week. And nothing big so far, but you're coming up to that first target resistance there, about 89.19, then 92.52. I'll give you another level right now because we'll probably have a hiccup along the way right there. I like that top of the gap, little reaction there, some reactions there. So that's T3 now. That's now T4 and potential T5 there. This thing can get some traction. PPLT, this is physical platinum shares ETF, and you have the downtrend line has now been taken out. That one was highlighted here at support recently. So it's doing okay. Again, nothing big. Just one way to diversify. And like I said, especially with gold and silver, if you do see the euro continuing to move down, That's most likely going to, I should say, my apologies, moving up. If you have any equity index shorts like the IWM short yesterday or anything, then if the euro moves up, that is going to most likely lift the metals as well, and that can offset. So that's why I refer to that as an indirect hedge to the stock market. Typically, because of that positive correlation that both the equities have and the precious metals have to the euro, which is an inverse correlation to the dollar. That's how you can trade that. And again, there are those periods of disconnects. That's why I call it an indirect hedge. You want a direct hedge. If you're long the NASDAQ 100, you can buy puts on the a NASDAQ 100 to directly hedge. So I like to do these indirect hedges when I see alpha, with the opportunity to either make money on both at times if I get the call right. In other words, short equities and long metals now. Metals may have that disconnect there and go up even despite a falling euro. And then if they don't work out, then usually they're going to at least offset. There are no guarantees when you do those indirect hedges. Sometimes you can lose on both. So just keep that in mind. Okay, and just recently, I think it was last week, I told you I liked select grains, particularly soybeans, one of my favorites, but I also see some developments in wheat that I like today, and corn will follow wheat, so I'll get to those in a second. They are the big three grains, corn, wheat, and soybeans. They even have, or used to have, one ETF that held all three. I'll have to check to see if that one's still around. The main ETF company or ETN company that had all these, they retired a lot of these ag ETFs last year. But here, let me go to soybeans first. That was, by the way, that was the I was showing you right there on ZS soybean futures that we broke out. There was that divergent low I highlighted, breakout, back test, and there'll be some stops along. In fact, there is resistance right here. I need to give that to you. We are at resistance on the futures. You can see we had a little support shelf here, several reactions, broke it, back tested from below. So we need to pop that about 1235. That should open the door to run up here. If you're a futures trader, but I'll get to the ETF in 1 second. Next stop about 1267, and then can power through there about 1297, almost 1300. SOYB, if you trade ETNs instead. And you can see I already have that same level marked, 2584. We're at resistance now, coming off a divergent low. So I would expect that resistance to get taken out, but it's TA 101. You don't buy at resistance. You either short or sell or take profits on your long, or wait for a breakout. So that's your next objective add-on. If you didn't take this last week when it was highlighted, you wait for a breakout, and then probably have that midpoint target in there somewhere about right here, I'd say. And then, ultimately probably up, all the way up here to about 20. It's not a huge trade. Again, the big point is on these, it can be certain commodities, certain securities, whether it be a commodity, a stock, a bond, have higher or lower volatility than the stock market. So that's where I came up with that term beta adjusted position sizing years ago, where if something has lower volatility like treasury bonds, I'll usually recommend at least a double sized position in treasuries because of the inherently low volatility. Then it makes it worthwhile. If you beta adjust your position size up for that, 10, it would be if you doubled sized, it would be better than a 10, 11% rally up to that target there. And if nothing else, it's also a completely separate asset class with just about zero correlation to the stock market, to treasury bonds. Grains are going to march to their own drumbeat. They're, supply, demand, weather conditions, crop problems, pests, things like that. Even, we learned that geopolitical risks when Russia invaded Ukraine and wheat went through the roof. So you have those other things going on there. So anyway, that's soybeans from the daily chart. It's kind of only thing I can tell you on the daily chart is we're coming off pretty deep oversold readings recently. The last time we were that oversold was right here, and you can see whether or not you wanted to be a buyer, whether you wanted to be a buyer or a seller at that point. Obviously a buyer. Time before that was right there. Obviously you wanted to be a buyer, at least for a trade, maybe not a trend trade, but a swing trade. That was a double-digit bounce. And then before that, it was right here, and you ended that with a slightly higher oversold reading with a positive divergence right there at the low. So pretty simple stuff, guys, and nothing's 100%, but if you take these shots, then over time, you're just putting the odds in your favor. So this is when you want to buy certain securities. Now, some things I look at and they become oversold all the time, or they hit that 30 level on the RSI and they just keep going, or they stay oversold. But you can see on this one, it's usually a pretty fleeting event once it becomes oversold, and then it's typically followed by a rally. That was a very near oversold, almost to the 30 level, and you still got a nice bounce there. All right, enough on that one. Take it, don't take it, that's up to you. Wheat I've been highlighting for a long time. It's just been grinding around in this range. I have a range right here. In fact, we put this one on way back here as a swing trade with multiple targets. We quickly we were off this divergent low, hit the first target, hit it again here, and that makes that an even more valid resistance level, about $6 than it was when I first put it as the target back here, because we've had two additional reactions off it, very distinct reactions. So that is a powerful level if and when wheat can take that out. In the near term, it did take out this little minor downtrend line today. It's back testing currently. I can put it up here if I want to be safe, and I'm going to do that now because I like to, give something the benefit of the doubt on the breakout. So we're right there. If we can, pretty much, I think if we can power above today's highs in wheat, then it should open the door for another run to the top of the channel. Ultimately, maybe not straight up. There's certainly some levels along the way. I can see one here. Usually, it's been my experience when you find a sideways trading range, a price channel, and that one is probably defined by that purple box. Somewhere about the midpoint, you usually get an area where you can see it acts as support and resistance, and that is about 586 on this one. Here's ZW wheat futures. You can see I already have that range is defined by this yellow box here, about 644, and down to about 569. Very, very well defined sideways range. And there's your midpoint, roughly midpoint line. I don't do the midpoint exactly at 50%. I look at it, and wherever I see the most number of reactions, again, usually you can see a line in there. So this is that downtrend line we just popped today I was talking about, and there's a secondary downtrend line. So just like wheat has to pop, WEAT, the ETN has to pop that, what was it, $6 level. We have to pop about 645 in wheat, and that we should run. And corn and wheat tend to move together, so I like wheat. I don't know. I typically just trade. I trade them both, but typically for some reason I just gyrate towards wheat a little more. Maybe the chart's just a little more conducive to my trading style. But you can see there's a nice resistance potential target there, about 2180. We are also coming off. I'll turn off all the lines here for you. Expand the RSI and show you we are coming off oversold levels. Oversold here, oversold there, oversold there, oversold there. And you can see what happened each time. Oversold there, boom, boom, double tap of the oversold reading. And again, this was just to kind of put it in perspective for you. That was a run up about 20%. Oversold here, a couple of double tap, 1, 2. Run right there. So even in a downtrend, they're usually good for easily double-digit gains. And I've shared my outlook, but again, for those coming into the site now, haven't been in a while, I maintain it appears to me that commodities ended a bear market back here when the stock market bottomed with COVID in 2020, and is by every technical metric, primarily trend lines, primary downtrend lines being taken out, and previous reaction highs being taken out. It has all the makings of a new uptrend, new bull market, and this I'm viewing as the first bull market correction. in commodities, and it's probably run its course at this point in time, or very close to it. Okay, those are the grains. This is Bitcoin. We'll wrap it up here, and then I'll do the separate video for the stock indexes and the components. I want to go through, which I did this morning. I spent most of the morning going through the top, I probably went down to the top 30 or so components of QQQ in order of market cap. And there are definitely some charts I want to cover there. But this is Bitcoin I threw out the other day as I take a shot here at this 40.56. Said you might want to keep, put a stop somewhat on the other side of that. We took that level out. And support, once broken, usually it's going to open the door down to the next support level, which we're coming up on that, about 38,000, a little above 38,000. This is the actual crypto here. You can see it's given us this wedge. From what I've read, after Bitcoin ETFs got approved, there's been just a tremendous amount of withdrawals, money coming out of GBTC, which was not an ETF. I've mentioned that many times over the years. Bitcoin Trust. It's a trust. It works similar to an ETF, but different structure, and it trades at a premium or discount. Either way, this is really good support as well. You can see we now have some pretty good, we have to reverse soon. We do have this bullish falling wedge with positive divergence. If we take out 3,800, especially if we go all the way down to the next support I have at about 35,627, it's going to take out the divergence. And remember, we're coming off a big divergent high. But fundamentally, I think there's a decent case to be made to get into Bitcoin with the approval of the ETF. But it works in reverse now. If we can pop 40,056, 40,560, that should really get this thing going. Of course, a pop above the wedge would as well. And so that's the Bitcoin crypto. That's a six-month chart with 3-hour candles. And this is BRR, Bitcoin futures. There was that gap. And so we took the bottom of the gap out. There was a top of the gap. We tried to bounce, got sold into. So you have pretty much the same technicals, obviously. We're just looking, these are the futures that track Bitcoin. And there's your bullish falling wedge. I have this line colored down a little because it's a little bit more of a minor support here, although it was better on the actual Bitcoin crypto. So it's worth noting. We are at support with nice, clean, positive divergences and a bullish falling wedge. So there's your setup. Whether you gave this room or you stopped out, it would be a re-entry or a new entry or an add-on if you're still in it on a break above the bullish falling wedge. Then again on break above 4207 right there, and especially if it gets back above 4100, it should probably start to rip if that happens. Otherwise, if it continues lower, if the buyers don't step in, I have next supports down here at about 36,800. Oh, you know what? I'm going to throw in crude, and then we'll wrap up. Just this is the futures have rolled from the last chart I was covering. Are we on these? Okay, yeah, these are the March. There's that divergent low I talked about recently that we traded crude, but this is a 6-month chart with 2-hour candles. This to me looks like a pretty significant resistance level right there, about 75.45. We can call it 75.50 if you want. You can see it was support back here, here. Punched through it once, had a little whipsaw, then it was support, then we broke it. And that gave us this big drop. Once that support clearly gave way, we ran up, tried to get through, nope. Tried again, nope. And we're trying again now. So that would be open the door for a move all the way up to about 80 would be my first target. That's a decent run. I don't know what that is, 6-7% or so. If we can run up there. So there's a potential target for you. That would also be a net negative for the stock market, rising crude prices, because that would, again, if you take in with what I just said on the grains, and there's some other commodities out there I like as well. Coffee's been rising, some other ones. Then it's going to, especially with a continued rise in yields, it's going to bring back worries about inflation again, and that's going to curtail or foil the Fed's plans, or at least the market's plan. The market has different plans for the Fed than the Fed has for the Fed, and that's lately they've been kind of coming to accept that. So that's it, guys. We got a lot to watch. Earnings coming up, a lot of economic reports this week. And then keep an eye on, commodities in general and interest rates. Obviously the biggest commodity out there is crude oil. That has the biggest impact on inflation, the most immediate impact. They don't. I believe, if I'm not mistaken, the CPI doesn't include spot grain prices, wheat, corn. It has the finished goods in there, loaf of bread, box of cereal, that kind of stuff. So, however, crude prices are quickly adjusted at the pump, whereas Special K, may take months or even years to, factor in any increases in the cost of the inputs. All right, guys, I'm going to wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.